Hi, folks. Eric from Hit Subscribe here, and I am doing yet another edition of our freelancer Q&A this week. I got my haircut since last week, so that's a positive development, I like to think. Office is still kind of a mess, but this is our second to last week, our penultimate week in this location. It's also, we're in the desert and it's raining. That doesn't happen often, and it's kind of messing with my light, but we take the good with the bad. The haircut, the beard trim, that's good. The mess in the office, the rain, not so good. It all kind of evens out. Anyway, all of that non sequitur aside, the question this week is there anything I can do about self-employment tax? So this is from somebody who, new to freelancing, has just discovered the joys of what in the US is known as self-employment tax. So I will talk through what that is. For those of you who maybe haven't gone the freelance route yet or haven't really experienced the full brunt of self-employment tax, I'll talk through what it is and then how you can't exactly avoid it. Well, I'll get into like how to mitigate it or what to do about it. At least to some degree, how I might play it with the rest of the video. So this is going to be all about the self-employment tax and strategies, I guess, for making it not hurt quite so much. Now, let me start out with the caveat I haven't had to brandish for a while, but again, I am not an accountant, so please take all of this. I'm not doing this to like weasel out of any accountability, but basically I am viewing all of the advice I give when I say that I'm not a lawyer or an accountant. I am looking at this advice as kind of me talking to a version of me that was just getting started, and basically here is what I would do in your position, or here is what I did do. So coming at this from the perspective of what I would do rather than advice of what you should do. I am not qualified to give that advice, but I am qualified to talk about what I have done or would do if I were you. So anyway, that caveat aside, I am again not an accountant, and this is truly something that if you have an accountant, I would talk to that person first, like full stop. That is a good first place to go. They will know the ins and outs and they'll understand your situation and have some recommendations. They will have better recommendations than I do, but there wouldn't be much of a video if I just stopped there. So let me explain a bit about this from my background, having dealt with this and my understanding of it, and hopefully it's something that is at least somewhat productive for you. So let's talk through specifically what we mean by self-employment tax. And for those of you outside of the US, I am not sure whether in any given country there is an equivalent of this. It wouldn't surprise me, but this might be kind of a US specific video. The person asking this question is US based, and a freelancer who has just come up with an unpleasant surprise, which is this existence of self-employment tax. It is not something that you are necessarily prepared for. I wasn't actually. For a number of years, I was a moonlighter. So when I would go to do my taxes, I was paying what's called self-employment tax, but it was kind of a drop in the bucket compared to my employment income. It wasn't, I'm trying to think of, it was a few years that I was doing stuff on my own before I really got hit full on in the face with self-employment tax. And it took the shape of me expecting to get a refund check from the IRS at tax time for a few $1,000s. Instead, I owed the IRS several $1,000s. And that was sort of a surprise, especially because I used to do my own taxes at that time. So that was my experience. And I believe the person asking this question has, sounds like recently gone through a similar sort of, oh boy. So what are we talking about with self-employment tax? Well, I'll try to explain this without getting too wonky about tax policy. But when you are an employee, like let's say that you graduate college, you get your first job, whatever the case may be, you become a W-2 employee of an organization, a full-time or salaried employee. When you do this, you fill out a form with your employer that talks about tax withholding, it's called. So as an employee, if you earn, $5,000 in a paycheck, when you actually get your paycheck, your pay stub, you will see that your total earnings is going to be $5,000. And then there's a bunch of deductions. It might be things like your 401k or medical that you're paying into, but there's also state tax. There is federal tax. There are what are called FICA taxes. So like, I forget what all goes into that, but Social Security, federal unemployment insurance, I want to say, and there's something else, maybe Medicare. And anyway, so all of these come out from your paycheck as deductions. Now, the part of it that you see is what's taken out of your paycheck. And I believe it's something like, so the the state and federal taxes are fairly significant. And then there are these other taxes that you are also paying into the Social Security. Well, I mean, I guess they're not exactly taxes. Anyway, there are these withholdings that happen from your paycheck. Now, when it comes to this transaction, it's actually more complicated than you realize. You see a series of transactions that are just between you and the governments, the state and federal government. So your 5,000 has, 1,000 held for federal taxes and 200 withheld for state taxes, and then so on down the line with like Social Security and Medicare and unemployment insurance. What you don't see is that your employer is also paying taxes like this. So every time payroll is run, there is money that your employer holds back and sends off to these various government agencies on your behalf. That's called withholding. But the employer also pays some taxes on its side on your behalf that you don't really see. Now, that's all fine and good. So you could think of the tax burden for you as an employee as being shared between you and your employer. Your employer pays some and you pay some, but you only ever see the part that you pay. Now, when you go off on your own and you start working for yourself, the various government institutions here look at you and say, oh, now you are an employee, but you are also your own employer. So I want both. And for you, I think the actual incremental tax burden that winds up happening is an extra like 7.5% of the total amount of money you wind up paying as the so-called self-employment tax. So part of it, like 7.5% or whatever, 6.5%, I forget the specifics, but I want to say 6.5%. There is this 6.5% of your total earnings that up until this point your employer has paid for, and you have paid for 6.5%. Now you're paying that whole 13%. And to you, it feels like the government in their various institutions is suddenly clawing an extra 6.5% of your earning. It feels like that to you, even though it's always been paid. You just weren't aware that your employer was paying it. So if you are used to earning, let's call it an even $100,000, let's say that you are paying, 20 or 30% in various forms of taxes, to the state, the Fed, and all these other things. Well, now you're going to be paying 36.5%. So the $100,000 you earned as an employee versus the $100,000 you just earned as an independent contractor, you pay $6,500 extra dollars in various flavors of tax now that you're self-employed. And that is called the self-employment tax. So that was a huge mouthful. I didn't mean to spend this much of the video explaining how it worked, but it's actually fairly complicated. So just to recap, you have earned $100,000 on your own and you have a concept of how much you pay in taxes, $100,000 working for an employer as an employee, and you pay 30% of taxes. That's what you're expecting to do. You're expecting that at the end of the day, you're going to keep 70,000 of your dollars. Well, when you go off on your own as an employee, as a self-employed person, you suddenly only get to keep, what's the incremental math there? The extra 6.5. So you only get to keep 43. It's failing me. But now there's 36.5% being taken out. So you lose, it feels like $6,500. That extra $6,500 coming out is self-employment tax. So the question here is, what can I do about this? How can I not get, shanked out of this $6,500? The short answer, in a sense, is there isn't really anything you can do per se. You used to be working for an employer who was taking care of that $6,500 for you, so you could think of that as a benefit. So I guess, in a sense, what you can go ahead and do is up your rates or billables or whatever so that you're taking in 107,000-ish, and then your total gross would remain comparable. So what I mean is, when you're thinking about going off on your own, you need to charge more because you need to account for the fact that there was this benefit being paid to you, sort of dubious as it may seem. Your employer was paying some stuff on your behalf. Well, now you're responsible for that, so your billables and your book should reflect that. So you should charge a little bit more. Now, there's a lot of other benefits that you are getting as an employee that you are not as a self-employed person that you also need to account for. That's why you might adopt a crude rule of thumb, like if you were making 100,000 a year, which is about $50 an hour, you should actually charge $100 an hour when you go off on your own, which would annualize to, what would that be, like, I don't know, 208,000, something like that. You should charge people at this higher rate, not because you're really making now 208,000 versus 100,000 before, but because you have all these extra expenses to pay for. One of which is these payroll taxes, this self-employment tax. So the first thing you can do is charge more. Another thing that you can do that is different than your world as an employee is you can start to think about taking more and more deductions. So when you're an employee, there are there isn't a lot of wiggle room, especially since the tax cuts that were passed like 4 or 5 years ago. Most people don't itemize on their taxes. So when you're just, working a W-2 job, there's not a lot of room for like tax deductions. When you have a business entity or you're working for yourself, you can now start to take a lot of tax deductions. And this might include some that you wouldn't think of. So this is where you really want to go talk to your CPA. So for instance, if you are working remotely or working out of your house, you can claim, say your office as a tax deductible expense. And that includes the portion of your office, say your office is 10% of your total square footage in your house. Well, that means that 10% of things like your home electricity, your home internet, your home gas and heating bill, your home sewer, et cetera, all of that becomes a business expense that you can deduct. And what deduction means is you take that $100,000 that you were hypothetically earning, and when you knock all that money off the top, you start to say, well, okay, after these deductions that I'm paying for my home office and my computer and all this stuff, I knock those off of my income because they're business expenses. And now suddenly my actual reported income, my adjusted gross income, it's called, is a lot lower. It's really only 80,000. And because that's lower, that proportion at 6.5% starts to go down. So you couldn't claim that money most likely as a deduction for anything when you were an employee. But now that you're on your own, you have these business expenses that you can claim. So that's a big way in the early going that you can mitigate self-employment tax. You can also do other things like, I don't remember anymore what this looks like, but if you set up like health insurance deductions, or you set up pre-tax, like a self-employed for solo 401k, things like that, you can further reduce your taxable income with like retirement savings vehicles or other pre-tax vehicles, college savings, something I just recently set up for Hit Subscribe. So there are these other ways to reduce your taxable income as well. And when you're reducing your taxable income, that 6.5% self-employment tax remains, but it becomes a 6.5% tax of a smaller and smaller pie. So these are all incremental things that you can do. Claim more business deductions, work with your accountant to figure out like what deductions you qualify for and can take, set up pre-tax vehicles for yourself so there's less taxable income in general, et cetera. So all of that is the, I don't want to call it easy, but it's the relatively straightforward way to do this. The more involved way to do this, there is a much bigger needle moving way to handle this, would be to change how your business files with the IRS. When you go off on your own, if you don't do anything, you are filing as what's called a sole proprietorship. If you take my advice that I've probably given in other videos, I'll dig it up on YouTube if I can. If you will file as you will incorporate as an LLC, and that means that you will file as an LLC, and that's kind of the same as filing with the IRS as a sole proprietor. And that basically means that as far as the IRS is concerned, they don't really care about those entities. That's the same, an LLC or a sole proprietorship. It's the same difference to them. They look at all the income that goes through that LLC or to you as a sole proprietor as if you were just getting money directly to you. So all of your returns are personal returns. Now, there is one thing you can do that I've done in the past, which is to set up, it's called an S-Corp election. And that doesn't change the fundamental nature of your taxable income as being passed through. It's still passed through. But what an S-Corp election does is it allows you to occupy two different roles as far as your business is concerned. So if you're running a partnership, an LLC, or if you're running a sole proprietorship, there is no distinction between you as an owner and employee. It's all the same difference. You're essentially just an owner. That's the only way the IRS really thinks of you. If you file an S Corp election, you can start to pay yourself as an employee of your business. And then you can also start to draw income as the owner of your business. And that is shareholder income. So what that means is that, say you go out and buy a share of Starbucks or something. When you earn dividends on your Starbucks stock, when they send you a check for like $1 a quarter or whatever they do, you pay income tax on that. But crucially, you only pay, I believe, state and federal income tax on those dividends. You don't pay those payroll taxes, those federal unemployment insurance, the Social Security, et cetera. So anything that you draw out of a business as dividend income, you're not paying self-employment tax on. Now, understand something here. This means that you, as the employee of your own business, say you start an LLC and you're doing application development for hire, and instead of just pass-through income, you say, okay, I'm working for me incorporated, or whatever you call yourself, and I'm going to do an S Corp election, and I'm going to pay myself a salary of $50,000 a year, and then I'm going to treat the other $50,000 that comes in as dividends. You have now two different streams of income. One, you're paying yourself a salary, so your business has to pay payroll taxes on that. There's the administrative fee of running payroll, which can be non-trivial if you're a solo operator, and there's the complexity of running payroll, but you are essentially paying yourself a salary, and there you, the business, are still paying both sides of the employer-employee tax. It just wouldn't be called self-employment tax because you're actually running payrolls now. So you are both the employer and the employee, and the employer you is paying those taxes and the employee you is having them withheld. But that other $50,000 in income where that isn't going on, in addition to your $50,000 in salary, you just pull that out of the business as what's called a distribution, and you're only paying federal and state income tax on that. You are not paying Social Security and these self-employment taxes. So in the end, let's say that you file as an S Corp, you do this S Corp election. This reduces your self-employment tax by categorizing, in the instance I mentioned here, half of your income is not subject to self-employment tax. So you're still getting all these deductions and things that you're doing that are reducing your overall income down to 80,000 instead of 100. But then you're paying 50,000 through payroll or whatever. So that remaining 30,000 you take out of the business is not subject to self-employment tax. That is a bigger way to reduce your taxable income, or at least the self-employment tax version of it. The other thing you could do is reincorporate as a C corporation. I definitely wouldn't do this if it's just to save a little bit of money on self-employment tax. The overhead of setting it up alone is very complex. Your filing is going to be more complex. There's all kinds going on there. But basically, if you incorporate as a C corp, which is what most of the companies you're familiar with are incorporated as, the business pays taxes, and you then also pay income taxes on it when you take out dividends. So there's another tax disadvantage here that is known as the double taxation penalty for the owners of C Corps. So they pay taxes, as the business that they own pays its own taxes, and then they pay taxes on their distributions. They also run payrolls. So in this case, I don't know how that would even out. I've never done the math on this, but you are trading a form of double taxation for a different form of double taxation, but with a lot more complexity. So I would categorically not do that if I were you. I don't think it's worth it. I've never heard anyone advised to do that to get out of self-employment tax. But in theory, if you did that, you would no longer be paying self-employment tax. You'd just be paying other taxes. So in the end, what I would advise you to do is claim as many deductions as you can. Work with your CPA, your tax person, your finance. What can I think of the word here? Your financial, whatever, whoever's advising you on this, probably a CPA accountant. I don't know, whatever you're doing. Work with that person to claim as many deductions as possible. That's your first recourse. Your second recourse would be to file the S Corp election. I would personally only do that if the I right off the cuff, unless like if you're under maybe 150, 200,000 in gross revenue, I probably wouldn't bother because you might start to break even there. But the overhead and complexity of setting up and executing payroll and then paying a CPA to generate what's called a K1 to do like a business tax filing, that comes with its own cost. So until the amount of money that you would save in self-employment tax starts to become pretty significant, I wouldn't do it. It's not really worthwhile. So I can't, this is where you need a professional to weigh in here. But as a gross rule of thumb, I personally, if I were giving advice to a younger, less experienced me, I would say until you're earning 150K a year through your business entity, this is not something to even look at unless you're starting to bring in an employee. So if you have to bring in an employee and you have to run payroll anyway, then go for it. But if you're operating solo and you're bringing in less than 150,000, it's unlikely to be worth it. And I actually, I learned this, I won't call it the hard way, but I hit this self-employment situation maybe 8 years ago. And I was a solo operator at the time and I set it up and it did in fact save me a good bit on taxes. So I was happy about that. But then just the pain and headache of getting a payroll provider and setting that all up just for a consulting business that I would later sunset a couple of years later anyway. It was so much of a headache in terms of the tax filing, the overhead, working with the payroll company, the whole 9 yards, that if I could go back and do it over, I wouldn't have done it. So I learned this by being pretty on the borderline, sure, saving some money, but then dealing with 2 years of headaches. So hopefully that makes sense. Just to recap all of this, how do you save on self-employment tax? The short answer is you really don't, just by going off on your own. This is just kind of one of those bummers. You can save some incrementally by taking more business deductions, work with your CPA on that. If you are earning more than 150K a year in revenue, let's call it, or you're starting to take on employees, then you might start to think about and look at this S Corp election. But understand if you do that, you're going to have to run payrolls and keep up with state labor laws and all kinds of stuff associated with being an employer that runs payrolls, which is not easy. So that's kind of where I would come down on that. For the person the person that was asking this, I would just try to go after as many deductions and pre-tax advantages as possible, and mark up your rates a little bit, and just kind of one of those cost of doing business things in life. It is a bummer. I wish it weren't true, but them's the breaks. So hopefully that helps, and I will catch all of you next time.